We are going to talk about another important topic in finance. This is the concept of risk and return. Net present value and risk and return are the two most important topics in finance. We will start with the introduction to risk. Our objectives for this chapter are to compute the realized or total return for an investment, calculate standard deviation, differentiate between sample and population, define and contrast idiosyncratic and systematic risk, and the risk premium for taking each on. If you look here at slide 3, you can see the stock price history for a company called Countrywide Financial Corporation from January 2003 to January 2008. You can see over different quoting periods what the return is on the stock. You can see that it varied greatly. The risk is that you may not get the return that you are expecting. If you bought Countrywide stock for $13.64 in 2003 and sold it when it peaked in January 2007 at $45, what was your annual return? We are going to solve for this return in Excel. Similarly, what if we held it another 6 months and sold it at $28.17? What was your return? Similarly, what if we sold it in January 2008 when it was selling for $6.96? What was your return? Using Excel, we would use the rate function to calculate return. Future value for the first one is $45. NPER, number of periods, is 4. That is 4 years. Payment is 0. That minus $13.64 will stay in all of our calculations as the present value. Payment will stay at 0 for all calculations. You can see if you were smart enough to sell it 4 years later, you got a nice return of 34.77%. But what if you thought, let me hold it a little bit longer until July? Now, NPER is 4.5 and future value is 28.17. Our return is a little bit less than 17.5%. And what if you said, let me hold it for 5 years? Then you can see that the return is negative. You certainly didn't buy that stock for a negative return. This is the risk that you may not get the return that you wanted. Now, we can look over investor history and see what if one of your ancestors or grandparents were smart enough to put $100 into different investments. How would that $100 have grown from the mid-1920s out to the 2020s? Our choices are the S&P large stocks, small stocks, the world portfolio, corporate bonds, or treasury bills. On this graph in slide 6, you can see that the small stocks performed the best, and the $100 would have grown to more than $10.3 million by the end of 2020. The large stocks to about $1.3 billion, the world portfolio to $417,000, corporate bonds to about $27,000, and treasury bills to just over $1,500, but still not a bad return over this 96-year period. The small stocks had the highest long return, but they also had the greatest fluctuation in price. Higher risk means we will require a higher expected return. You may not realize that expected return, but that is what we are saying. If we've got to take risk, then we've got to see a higher expected return. We are therefore going to assume that we are risk averse. Few people ever make an investment for 96 years. More realistic investment horizons and different initial investment dates can greatly influence each investment's risk and return. The next slide, which comes from your textbook, shows the value of $100 invested in alternative investments for differing investment horizons. There are details in the notes page of this the slide, which you can see by viewing the notes page in the PowerPoint. So let me share my screen and view the notes page. So that you can see it. In our next video, we will calculate arithmetic and geometric returns. Thank you.